Hello everyone, thank you for watching this video. Welcome to the very first video on financial analysis. When it comes to financial analysis, I usually have a number of steps to study the company's financial numbers. First thing first, I always look at the company's profitability over the past 5 to 10 years. Step number 1, we look at the company's revenue, profits, and EPS or earnings per share trend. So what is revenue? Revenue or sales is the income that a business receives from its normal business activities. It is the income the companies receive by selling products, services, or financial assets to the customer in a particular period of time. So revenue is actually a function of two factors: the price of the products or service the company sell to the customer, and the volume, how much volume the company sells to the customer. So if a company shows a rising revenue over the past 3 to 5 years, it means that company is gaining market share or expanding the business volume, or the company is able to raise the price of the goods or services that sells to the customer. So on the other hand, operating earnings or operating profit is a measure of profitability from a company normal core business operation. It simply means revenue minus the cost of sales minus the operating expenses. Net earnings or net profits is a measure of profitability after accounting for all costs. So for growth investing, we have to see these three financial numbers are growing over time. Next, I want to show you the graphical representation of the company's profitability. So I want to show you how the company's net profits is derived. So on the left hand side, I have the revenue, which is the top line in the income statement. So we know that revenue is the income the company receives from their customer by selling the products, goods or services. So revenue minus the cost of goods sold, we get the gross profit. Cost of goods sold is the direct cost. It's a cost that is directly involved in producing the products or services. For example, the cost of inventory, or the labor cost that is involved in producing the product or services. If we use the gross profits minus all the operating expenses, as well as the depreciation and amortization expenses, we get operating profits. So what are the operating expenses? Operating expenses are those, for example, selling, general and administrative expenses, R&D, research and development expenses, and other expenses. Depreciation and amortization expenses are expensing the fixed asset, for example, the property, plant, equipment, and intangible asset over their useful life. Because the company need to buy equipment, need to buy the buildings to operate their business. And that's why the company need to capitalize these expenses over their useful life and record it as expense in the income statement. So what is left is the operating profit. So we know that some companies also have investment in other companies, and they do not take part in their operation in that company. So those income, those profits that the company receive from those investments, we call it non-operating profit because it's not part of the core business operation. So if we add these two together, if we add these operating profits, non-operating profits together, we get EBIT, earnings before interest and tax. Some companies also borrow loans from the bank. Because of that, they need to pay the interest on the loan. So they need to incur these interest expenses. So EBIT minus interest expense, we get the pre-tax profits. Of course, company need to pay government tax. So pre-tax profit minus tax, we get net profits. So the net profits is the bottom line of the income statement. So if we divide this net profits or the net earnings of the company by the total number of shares, we know how much net earnings is allocated to one share of the company's stocks. It's given by this equation: earnings per share equals net profits over total numbers of shares. So for total numbers of shares, we usually use diluted numbers because we like to include those securities that could potentially be converted into shares, such as stock option and convertible bonds, because we do not know one day in the future whether the management of the company or the employee of the company will exercise their stocks, and this will increase the numbers of shares in the market. So in the most of the time, the share price of the company will follow the earnings per share trend. So let's do a case study to practice what we have learned just now. So today's case study will be Micromechanics, a Singapore listed company that is involved in semiconductor business. So if you look at the revenue and net profit numbers, they are actually growing over the past 10 years, which is a good sign the company is growing. If you look at the company earnings per share (EPS) trend, it is also rising. So it means the company is actually doing well in its business, either by gaining market shares or raising the price of the goods the company sells to the customer. However, there are also weaknesses to by just looking at revenue and earnings metrics alone, because we do not know how well the company management is deploying the shareholder capital at generating this profit. So that's why we need to study the company's return on equity, the ROE, to understand more about the company efficiency. So we'll share more in the next video. So I will see you in the next video.